Welcome to this explainer. We're going to visually decode the massive market shifts happening right under our noses right now. We're talking everything from a colossal corporate pivot at the very top all the way down to your personal portfolio strategy. We are tracking some seriously wild swings out there. Semiconductor giants dropping one day, high-growth energy drinks surging the next, and honestly, if you aren't paying close attention to the underlying mechanics of all this, you could easily get left behind.
So, let's just dive right into our roadmap for today. First, we'll look at Meta's AI cloud shakeup. Second, how to hedge the chip trade. Third, spotting the next growth breakout. And finally, number 4, building a portfolio for the 2030s.
All right, Section 1, Meta's AI cloud shakeup. To kick things off, we really need to look at a recent Bloomberg report. It revealed a huge change in Meta's business strategy. And guys, this could send absolute shockwaves through the entire tech sector. We've got to ask this absolutely crucial question. Did big tech overorder AI chips? We're asking this because Meta is now reportedly planning to build a cloud business just to sell excess AI computing power to outside customers. Just think about that for a second. If you're selling off your own computing power, it heavily implies you bought way more infrastructure than you actually need to run your own core business, right?
Well, this brings up this fascinating concept of CapEx FOMO. That's capital expenditure fear of missing out. According to our source analysis, it is exactly like ordering way too much food at a fancy restaurant just because you're starving when you sit down. But then, when it all actually arrives, you realize you've got to go around selling your excess lobster and filet to their tables just so it doesn't go to waste. Executives at these massive tech companies frankly admitted they would much rather overspend on AI infrastructure than be caught being too conservative. And now, we're literally seeing the proof of that overspending.
And this causes a massive ripple effect across the whole industry. Look, if Meta has all this excess supply, chip giants like NVIDIA, AMD, and Micron might suddenly face a drop in future customer demand. Why? Well, because if companies can just go and rent excess capacity from Meta, they simply don't need to buy as many raw chips. Plus, existing cloud giants like Amazon's AWS, Google Cloud, and Microsoft Azure, they now face a fierce, founder-led competitor stepping onto their turf. Zuckerberg is aggressively spending. We're talking to the tune of an estimated $140 billion in CapEx this year, and it's creating a very real dent in the seemingly unstoppable armor of the whole chip trade. Moving on to Section 2, hedging the chip trade. So, if big tech really has overordered these chips, how on earth do you position your investments without getting totally wiped out by the volatility?
Here's the crucial takeaway. You hedge your portfolio by owning both the chip spenders and the chip makers. Think about it like this. If CapEx moderates, meaning these companies finally stop spending so intensely on infrastructure, the market is likely going to reward the chip spenders, companies like Meta, Amazon, and Google, for being more financially disciplined. But if the CapEx spending spree just continues uninterrupted, well, the chip makers like AMD and Micron will just continue to rake in absolute fortunes. By structuring your investments this exact way, you ensure you're covered whether companies dial back their spending or just double down. If AMD sells off heavily on any given day because of infrastructure fears, your Meta or Amazon holdings can step in and pick up the slack. This lets you safely ride out this kind of kangaroo market we're in, where things are just jumping wildly up and down, instead of pulling your hair out trying to perfectly time every single entry and exit. It's just a much smarter way to play it.
Which brings us to Section 3, the next growth breakout. Let's pivot away from the mega-cap tech giants for a minute and look specifically at high-growth stocks. This is where the volatility gets wild, but man, the rewards can be incredible.
Just look at LF Cosmetics as our prime example here. This stock recently surged more than 60% from its June bottom in less than a month. 60%! This perfectly proves that when high-growth companies finally get moving, they move rapidly. They can completely shock the market with their sheer speed. But before you go chasing those massive gains, you need to burn this reality right into your brain. Every single great high-growth stock, from Apple to Tesla to NVIDIA, has experienced absolutely brutal crashes. The source material emphasizes this over and over. You literally cannot find a massive growth winner that hasn't cratered 50% or more, often multiple times in its public history. You absolutely must have the stomach for extreme pullbacks if you want to play in this arena. So, keeping that high-risk, high-reward mentality in mind, our source analysis points to Celsius Holdings as the next massive growth breakout candidate. And listen, this isn't just a single product company anymore. They are an aggressively expanding energy drink powerhouse. They're growing their portfolio with brands like Alani and even acquiring the legacy brand Rockstar from Pepsi to revive it. They are expanding their market share rapidly, And despite recent pullbacks, they are positioned as a significantly undervalued opportunity right now.
And there is an undeniable historical pattern here that we have to talk about. Year after year, in 2022, 2023, and extending right into 2024, Celsius has suffered these steep, terrifying crashes, only to rebound and double in value within a matter of months. It's crazy. It is setting a remarkably strong historical precedent for its future movements, and based on the analysis, we could very well see a repeat of this explosive crash then double behavior as we look ahead to 2025 and 2026.
This perfectly captures the extreme psychological whiplash of growth investing that you have got to master. Seriously, 1 minute your stock is up 80%, and you're trying to figure out what color Ferrari you're going to buy. The very next minute, it's crashed 50%, and you're wondering if you'll be eating ramen noodles for the rest of the year. It's this constant, visceral battle between luxury dreams and worst-case nightmares.
All right, let's get into Section 4, Building a 2030s Portfolio. This is our final and arguably most important section, how to step away from all this daily chaos, stop making emotional, self-inflicted mistakes, and architect a portfolio that truly lasts.
To protect your capital, especially when you start hitting those six-figure portfolio milestones, you need structure. Enter the GVD 123 framework. Basically, this means anchoring your wealth across 9 core companies evenly distributed. You pick 3 growth stocks, 3 value stocks, and 3 dividend stocks. Simple, right? Then, within each of those categories, you allocate the majority of your capital to your number 1 conviction play, slightly less to your number 2, and slightly less to your number 3. It keeps you balanced and absolutely prevents you from disastrously going all in on just 1 or 2 speculative ideas.
If you want to avoid those brutal self-inflicted wounds that can literally set your wealth building back by years, you absolutely must follow these disciplined steps. First, stick to that core 9-stock GVD structure. Second, do not mess around with margin or borrowed money. Just don't do it. Third, when you have a massive win on a stock, do not let greed trick you into buying risky call options just to chase an even bigger high. And finally, let the market come to you instead of forcing trades. You have to force yourself to be patient.
This legendary piece of advice from Warren Buffett perfectly anchors our entire mindset for this explainer. He says, you don't have to swing at all the pitches. In investing, there are no called strikes, guys. You don't need to capture every single short-term movement, you don't need to buy every single hot tech stock you hear about, and you definitely don't need to swing at every pitch just to build incredible, life-changing wealth over time. Let the market come to you.
This is where the rubber really meets the road. If you're just trying to gamble your way into buying a new flat-screen TV to watch the game next month, well, this strategy probably isn't for you. To win big, you have to completely shift your timeline. You got to start thinking 5, 10, even 20 years out. You are buying companies today that will dictate your wealth in the 2030s.
And so, I'm going to leave you with this provocative thought to ponder as we wrap up today. Take a hard look at the exact stocks sitting in your brokerage account right now. When you evaluate those companies today, are they the resilient innovators, the strong value plays, the dynamic growth engines, and the steady dividend payers that you feel genuinely comfortable holding for the next decade? If the answer is no, it might be time to put the GVD 123 framework into action. Thanks so much for learning with me today in this explainer.